When everything rises together, stocks, gold, real estate, even Bitcoin, it feels like the world is unstoppable. Social media celebrates new records every day, and investors believe the boom will never end. But what if this euphoria is actually a warning sign? Because in every market cycle, when everything looks perfect, that's usually when the danger hides the best. One, the euphoric phase. Right now, the S&P 500, NASDAQ, semiconductor stocks, gold, housing, and even Bitcoin at $120,000, all at record highs. People feel rich, confident, and fearless. They say this time is different. But history teaches the opposite. Every major crash, from 2000 to 2008 to 2021, began when people believed the good times would last forever. The moment everyone feels safe is usually the moment the storm begins. 2. Why everything is up. Why is everything rising together? It's not magic, it's money. Interest rates have peaked and are now falling. That means cheap credit, more liquidity, and investors chasing higher returns. When money leaves bonds, it flows into stocks, gold, crypto, and real estate. Central banks cut rates to support the economy, but those same cuts often inflate the next bubble. And in 2025, the signs are familiar. Governments are deep in debt. Corporations borrow to buy back shares. Retail investors FOMO into anything that moves. Everyone's playing musical chairs, but the music can't last forever. 3. The hidden danger of overvaluation. When everything is expensive, the risk is not in the price. It's in expectation. People believe central banks will always save the market. They think technology or AI will keep profits growing forever. But when everyone shares the same optimism, there's no one left to buy. That's when smart money begins to leave quietly, rotating out of growth and into defensive sectors. Healthcare, utilities, consumer staples, they don't announce it. They just move, because capital is cowardly. It runs to safety before the crowd even realizes something's wrong. 4. What happens next? So what happens when everything is this high? Usually one of two things. 1A, soft landing, where markets cool off slowly and earnings catch up. 2. A liquidity shock, where one sector, crypto, housing, or tech, collapses first, pulling the rest down with it. Remember 2022? The Fed raised rates too fast. Bitcoin lost 70%, tech stocks crashed, and the world panicked. Now the reverse could happen. Rates fall, bubbles expand again, until something breaks. 5. The smart strategy. This is not the time to panic. It's the time to protect. You don't need to sell everything, but you should start locking profits and reducing risk. Trim your biggest winners. Avoid heavy leverage. Keep 10 to 20% cash for opportunities. Rotate part of your portfolio into defensive stocks like healthcare, CURE, JNJ, UNH, utilities, XLUNEE, consumer staples, XLP, PG, KO. Because when growth slows, those sectors still pay dividends and hold value. Protecting profit is also profit. 6. The psychology of greed. Why is it so hard to take profits? Because greed whispers, maybe it'll go a little higher. But markets don't reward greed. They punish overconfidence. Think about it. When you bought early, nobody believed you. Now everyone agrees with you, and that's dangerous. When the majority finally joins the trend, it's usually near the end. That's how cycles work. Optimism peaks before reality hits. 7. Historical echoes. Every generation repeats the same story. In 2000, tech stocks were the future. In 2008, real estate never went down. In 2021, crypto would replace money. Now, in 2025, everything is AI-powered and inflation-proof. Sound familiar? The pattern is always the same. Cheap money, speculation, all-time highs, euphoria, correction. 8. The exit of smart money. The smartest investors don't ring bells when they leave. They just shift quietly, taking profits while the headlines still celebrate. When you start seeing retail investors open trading accounts, celebrities launching crypto tokens, and everyone talking about how easy it is to make money, that's not opportunity. That's exit liquidity. So instead of joining the crowd, start thinking like the professionals. Reduce exposure while everyone else adds risk. 9. Conclusion. Markets move in cycles, not straight lines. No rally lasts forever, and no crash lasts forever either. The goal isn't to predict the top, it's to stay disciplined and protect what you've already earned. So while the world celebrates new highs, remember, the higher we climb, the thinner the air becomes. Stay smart, stay calm. And as always, this is JP Finance.